And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. Let's get started here. As usual, we are going to be taking a look at where we closed the week. Pretty critical period here as it relates to support for the broader markets. So we're going to take a close look at the S&P and the NASDAQ. And then also some of the top headline news that drove price action this week. Quite a volatile period, and we'll get into that as well. Value versus growth stocks and buying on the dip. So we are going to take a look at which of those areas outperformed this week. I think you can guess, and how you can identify stocks that could possibly be good buys on their pullback, simply because next week, statistically, is the good old Santa Claus rally. It takes shape the last 5 days of the trading year and then the first 2 days of the new year. So it doesn't mean it will occur, but it's always helpful to be on alert, certainly if you are a shorter term trader with your outlook on your trades. So from here, let's go ahead and take a look at some of those headline news. As mentioned, it was quite choppy last week. First up, we did get the closely watched consumer price index numbers, and that's a number that the Federal Reserve, among others, pays very close attention to. They are on the lookout for inflation to begin receding. That number did come in lower than expected, pushed the markets higher, certainly earlier in the week. But beyond that, we did get news on Wednesday that the Fed funds rate was hiked by 0.5%. That was very much built into the markets. However, I have that number incorrect. That peak rate that Fed Chair Powell is targeting is actually 5.25, so a little higher than anticipated. So that plus comments from Fed Chair Powell stalled that rally attempt. Also, news on that day was that, in fact, Fed Chair Powell forecasting gross domestic product, that GDP, and it was lowered to 0.5% for Q1. And that is very, very close to a recessionary level. Hence, the markets sold off on that, as well as I mentioned Fed Chair Powell's comments that they intend to keep interest rates elevated until the inflation rate gets closer to that 2% level, and we are just not there yet, anywhere close, really. So it does imply elevated interest rates into 2023. On Thursday, we did get weekly jobless claims dropped. That is, as usual, a case where economic news that's generally positive is negative in the sense that this employment factor is very critical for the Federal Reserve. They want the unemployment rate to rise as a way to slow spending and hence inflation. Retail sales did post a large decline. However, it was due primarily to car sales numbers. So in the end, not as much of a drop. Consumers are still out there spending despite higher prices. Next week, actually, we did get a PMI report later in the week, a flash S&P 500 PMI report that does point to a weakening economy. So overall, some mixed numbers, but at the end of the day, the recession fears remain front and center, so the markets did fall for the week. Now, next week, we will get another critical employment data point, and that's going to be that PCE price index. And then also housing data is due next week. I point that out because housing stocks were on the move. It was one of the few bright spots on days when the market was down. So we'll see how that fares next week as those numbers are reported. So from here, let's go ahead, take a look at the S&P 500. I'm going to refresh my screen here to see how we did close for the week. And here we are, this red 50-day simple moving average is that really quite critical level that we need to pay attention to at this point in time. We had this spike up here in mid-November that marked the beginning of this bear market rally. So from here, Ideally, we wanted the markets to be able to close the week above that 50-day simple moving average. That would be a 3863. So we did close the week at 3852. So we are below that 50-day simple moving average. Of course, we are going to see high volume because today was triple witching day. However, not pleased that we are now dipping below that 50-day simple moving average, because the outside momentum indicators, your RSI here and your faster moving stochastics, are both in negative territory. So for all intents and purposes, this bear market rally has been halted. So the other thing that I did want to point out, I will get more into this with my MEM Edge report, but using historical precedents as your guide, we simply need only go back to this July into August rally, take a look at those metrics and those characteristics that were in place when this particular bear market rally also faltered. So keeping an eye on that. Let's move over and take a look at the NASDAQ composite. This index was down more than the S&P 500, not unusual of late. And what we can see here is that the NASDAQ closed below this 50-day moving average on Thursday and then continued to trade beyond that lower. We can see the RSI and the stochastics also in negative territory here. So as it relates to this growth heavy index, we will now need to look at prior recent lows for the next area of support. So not very good standing there as well. Let's go ahead from here and take a look behind the scenes. We want to see sectors where relative strength is maybe remaining or not, and if there is anything in the way of sector rotation taking shape. Now, we're not usually in a 1 week period. You won't normally see groups jump. This type of view is going to be more subtle, where you'll see groups that were up here in the forefront potentially move down to this lower quartile. Up here are your stronger relative outperforming sectors, and then down here, your weaker areas. In fact, that's exactly what we saw with energy. Energy was the top performer this week, up 2.4%, while the broader markets were down 2%. We can take a quick look here. The next period, I'll share with you what took place and why. Energy stocks had a bit of a relief rally here, but we can see that it does still remain in that lower quartile, and we are still in a confirmed downtrend. Another area that we can take a look at up here in the forefront is that utilities, staples, healthcare remain up here in the forefront, and these are more defensive, higher yielding areas of the market. So that particular weight, as we've seen over the past several weeks, remains in place. And one area that was up here in the forefront that fell into this middle ground here, potential rotation taking shape, is REIT stocks, XLRE. This particular group was down not a whole lot for the week, but it did get hit as recession fears begin to increase. You will see pressure on these REIT stocks simply because there will be fears that potential, whether it's apartment building and other rents, may not come through, or the fact that there would be less leasing activity in the face of a recession. So other areas that we can take a closer look at, and definitely bears a closer look, is the fact that the financial sector fell back below this 50-day simple moving average. Outside momentum now in negative territory. This is an area that had sharply had an increase here, and more recently showing a lot in the way of weakness. I'll share with you some reasons why and some stocks that are on the move there. So from here, let's go ahead and look beyond those S&P 500 sectors and take a look at some of the sub-industry groupings in the markets. And this is where I populate this 2-month daily price chart view with ETFs that I find super useful as far as really getting your arms around what is shaping up in the markets, where that relative outperformance is, as well as that weakness. Make sure you're not overweighted in those weaker areas. So up here at the forefront is gold. I've talked about this in the last 2 weeks as gold stocks continue to retain a presence up here. in this case, just dipping below that 200-day simple moving average. The group overall was flat, but this is in the face of a negative market. So we are seeing vibrancy here. And let's take a look at another ETF in that metals space that is acting even better. This is silver SLV, that iShares silver grouping, and we can see a nice confirmed uptrend. I highlighted this stock back here on your daily 5 a couple of weeks ago. From here, we can take a look at other areas that are moving from this lower quartile up here to the top. And unfortunately, it is volatility. And it's kind of interesting. I'm going to pull up a weekly chart here because volatility actually for the week was down despite this choppy period we've just come away from. And it is back down here in this 22, 23 level. So not as elevated as one might anticipate given the news last week and certainly fears by way of recession. So when we are in this rising volatility period, also VIX index known as the fear index, that is a negative backdrop for the markets. So not sure what to make of this choppiness, and actually that volatility closed the week down just a bit, but it did move up here to the forefront given its general predisposition earlier in the week in that spike higher. Up here also in the forefront, biotech stocks, and this is good news certainly from subscribers to my MEM Edge report because we are overweighted in these biotech shares simply because there's a lot of vibrancy within the biotech space with clinical trials coming through positively, FDA approvals getting closer to formation, and then some of these larger biotechs actually coming out with really good numbers and offering yields. So take a look here. We can see that 132 level was support for the ADBE index. I'm just going to take a second here and mark that up so you can see what I'm pointing out. And take a look here. So you want to keep your eye on recent lows when you are looking for whether it's a stock or a broader market index. Can that particular, in this case, ETF hold support there at that 132? It did. And then into the close today, we saw buying. Another metric that you want to pay attention to if you are really keeping a close eye on your holdings, you're looking for relative outperformance. When you experience that pullback, take a look at that RSI. Now, it did dip below that 50, but we are generally up there still in constructive territory, MACD still in positive territory. So keeping an eye out on that area, as among others within healthcare, because healthcare, as stated, is up there in the forefront as a relative outperformer. Other areas that we can take a look at, I mentioned that oil stocks were up this week, and we can see that 4 out of the 5 days, the price of oil, this is Brent crude oil, we did get down to that 75 level and we're able to trade up to 82. Today we were down a bit, but by and large, this increase in oil did help select oil-related stocks, energy names rally, but this too is still in a downtrend. And then from here, another area very much worth looking at is interest rates. This is the yield on the 10-year Treasury, and we can see that it does still remain in a downtrending phase despite Fed Chair Powell's remarks relating to an elevated rate. But there is one other thing that I do want to share with you. We can get more into this, but I talked about financials turning negative, and one of the primary reasons, this is KRE, that S&P 500 regional banking ETF has fallen off a cliff. I've talked about this in the past, and you can see the super high volume. Banks are definitely under distribution. When I complete this session, this segment, I will share with you one of the reasons that these bank stocks are getting hit rather hard. US dollar mostly flat for the week. We can see it is down here, but not doing a whole lot. So we're not seeing a lot of impact as it relates to that. We can then go ahead and take a look at some of these growthier areas that I've populated this ETF view with. and take a look at semiconductor stocks. They actually were down quite a bit. This is an area that had been showing very promising move above this 200-day simple moving average. We had nice high volume. This was that CPI related rally, but then Fed Chair Powell's comments threw cold water on that potential downtrend reversal, and we are now back down in negative territory. Semis down about 3% for the week. So let's go ahead from here, and I did want to share with you something I have not talked a lot about, but it's a part of my work, and that is a view of the U.S. Treasury yield curve. Down here on the bottom with this particular view, there are many different ways you can take a look at this, but on the lower portion here, we have 1 month, 3 month, 1, 2, 3, 5 year, and so on out to the 30-year. And what the significance here is that we can see short-term interest rates are very elevated. We're up here at about 4.7 on this 6-month, 1-year view. You can actually scroll through this. This is US Treasury yieldcurve.com. But most important when we are looking at this is the fact that shorter term rates are much higher than the longer term. So this inverted yield curve, two things. It is telling us that investors feel there is a recession. That's one of the signals. But also, when you think of bank stocks and their lending activity, the way they operate is they borrow funds at shorter term, normally lower, shorter term interest rates, and then they use the longer term, normally higher interest rates as the rate that they charge. So in essence, when we have this inverted yield curve, the ability for them to attain profit margins on lending activity is greatly reduced. So let's go ahead from here and move on. I believe I did mention value versus growth as something that we can take a quick look at. So first up, what I did want to share with you are the components of the Dow Jones Industrial Average. The Dow, again, was relatively the best performer, down 1.5% relative to the S&P down 2%, NASDAQ down 2.5%. And by and large, this is viewed as a more value-oriented. It has now a couple of, over the last 5 years, newer growth names in there, but heavily weighted on more value stocks. So let's take a look. This is a 2-month daily price chart view of the components within the Dow, those 30 stocks. Again, that RSI here, and then sorted it in descending order. So these are stocks that have been relative outperformers up here at the forefront. We can take a quick look, for instance, at Procter & Gamble, super strong uptrend after reporting strong earnings in here. And then let's just take a quick look at an intra-day chart to see how did Procter & Gamble fare today. So we can see that this particular stock did pull back a little bit in line with the markets. However, into the close, we did see buyers coming in to this particular stock. I'll just take you through a couple of these names, and then from there, we can take a look at other areas that are growthier. Quick look, Coca-Cola here, another name that pulled back not as much as the markets. I talked about paying attention to that RSI. Is it still up there in positive territory? Another quick look at that intra-day chart, and we can see that into the close. Now, unfortunately, that last 15 minutes, we did see sellers coming in, but for the most part, buyers coming in, supporting these value stocks, certainly not just today, but for the week. You can see that a lot of these names up here in the forefront have outperformed the broader markets and held in really quite well. We can look, for instance, at Caterpillar, and it was actually up 2.4% for the week. So quick view there of these more value-oriented names that offer high yields. And we can then from here just go ahead and take a view of growthier FANG stocks, these heavyweight names in the each of the broader market indices, mostly viewed or primarily viewed as growth stocks. And you will see a different view as it relates to their performance, not only for the week, but into today's close. So Apple, for instance, was down over 5% this week. And if we take a quick look at an intraday, and a lot of what I'm sharing with you now is going to be for investors that are a little faster in their trading or shorter term, but of note. So here we are with a 15-minute view of Apple, and we can see this is the deterioration that it experienced this week, but we did not get that strong buying that I was sharing with you in those more defensive consumer staples, value type names. We can take a look at another name here, Amazon. That particular stock actually was not that bad this week, down 1.7. So from here, well, I will share with you, I don't want to spend a lot of time here, but let's just take a look at Meta, because this particular stock had a big upgrade today. JP Morgan, it was very big news. They upgraded their outlook for Meta platforms into next year, and they also raised their price target. So the stock did originally rally on the news, but unlike those other names that I was sharing with you, Coke, Procter & Gamble, and so on, we can see this initial gap up on that bullish price increase from Wall Street. It actually deteriorated into selling. So a long roundabout way of sharing with you the fact that overall, those more defensive areas of the market are holding up better, are seeing buying going into next week. And then, of course, there is still the possibility that we may see a rally, and we are in an oversold position going into next week, so it would not be entirely out of line. So a couple of other things that I wanted to share with you if you are on the lookout to potentially participate if we do see signs of the markets regaining their 50-day, any kind of rally attempt, and sharing with you some of the characteristics that I would be on the lookout for. This particular company, CELH, is another consumer staples name. It is a beverage, fitness type beverage, and we can see that it pulled back with the markets, but again, held in better than the markets. And your momentum remained constructive despite this crossover here. And we closed the week above this 21-day simple moving average. So that would be the kind of name that would be of interest to me. It's not going to be super growthy, but of interest. Other areas that also saw buying today after yesterday's pullback, STLD, but this was all about U.S. Steel's earnings. However, we can see that the momentum has shifted. One last name. This is a screen that I ran earlier in the day. So Halozyme, the HALO, a biotech company, again, held in remarkably well, pulled back, found support at this purple 21-day simple moving average, and then closed the week above that with your outside momentum up there in positive territory. So from here, we can take a look at a couple of names that reported earnings this week, two different views. First up is today, Adobe came out with numbers that were strong. Their revenues were not as strong as anticipated. However, the stock did rally on the news. Super big volume. Again, we'll see volume today given triple witching, but overall, when looking at names such as Adobe that came in, gapped up on the numbers, you will want to be very aware of not only that industry group it's a part of. Here is IGV, the ETF for software, back in a downtrend, but then also that sector, XLK, which had this reversal similar to the broader markets up above that 200 and just barely clinging to that 50-day simple moving average. So not of interest, certainly to me, but we can also look at a company that is due to report their earnings next week. And interestingly, they are pulling back quite a bit going into the numbers. This, of course, is Nike, NKE, and it was really on its way, seemingly, to reversing this lengthy downtrend with a break above that 200. However, it is pulling back going into numbers, and there are any number of other shoe-related stocks that are holding in fairly well. So Nike is one of those market movers, so you will want to be on the lookout for their earnings going into next week. Another company that did receive an upgrade, I talked about Meta, JP Morgan raising their price target to 150. But another company that is in the energy space, but offers a really nice yield. Now, this one actually fizzled into the close, unfortunately. This is Sunoco. It is a limited partnership. They offer a 7.5% yield. They did receive a Wall Street upgrade that originally had it looking pretty interesting, but into the close sold. So we'll be keeping an eye on that one. This particular company is all about supplying oil and gas to gas stations. So that is their primary business. And again, if I didn't mention it, a nice 7.5% yield. I am going to close it there. Everyone, I hope you have a fantastic weekend. Look forward to seeing you here next week.